Hi, by the end of this session, you will get a sense of a positional trading strategy that you can apply in trending market in crude oil futures on a weekly basis. Now let's look at the basis or the basic concept behind this strategy. Usually there is a huge volume pile up in the first week of the month and the last week of the contract. This pattern is followed in the first 2 days of the week and the last 2 days of the week. So a week on volume in general look like this. You can see in the picture. And this is inferred from the last 5 year volume data. It's not perfectly accurate, but it depicts generally what is the outlook. As the week starts, the institutions sometimes open up the positions in first 2 days. Then these are closed by the week itself. This strategy is followed by many financial institutions. This can have a huge impact on the volume of crude oil futures. The main reason for not carrying positions during weekend is crude oil futures in international market are around the clock trading instruments. Hence, they carry a high risk exposure even on non-trading days in local market. How to trade this information? The process looks like something like this. You have to first have to look for the day of the week, and this in this strategy, the entries are often taken on Monday and Tuesday. If we pass Tuesday, from Wednesday we don't take any position. That means there is no trade. The first cue we have to look for is there should be a trending market. In the trending market, we take positions on Monday and Tuesday, and by Thursday and Friday we exit the trade. The trade in this strategy is often positional trades, so you have to buy the full contract. That means it's not have to be done with the intraday leverage. The risk often carries to 7% to 15% of the invested capital, and it gives a result to 2 to 4 times, realizing a profit at anywhere above 10% on this trade is practically possible. Then again, it's trading, so there is risk. And these trades often pay off better in buy side than sell side. That means you are better in longs and not so good in short. Hence, it is preferable not to execute the trade based on this strategy if the aligning trend is short selling market. You will not be placing a stop loss order for this trade, but you will be constantly engaging in the trade and closely watching the price. Hence, the stop loss is an activity that is done by yourself. And also, the trades placed on this method can be exited usually by Thursday evening, since there is a slight inverse relationship that is shown by increased trading activity in natural gas contract, another energy contract future in commodities market. This strategy is purely trend driven, hence doesn't have any impact by the price action in the short run. On a final note, if you have no idea about institutional trading in crude oil, it is better not to trade in this method. For taking positions in the trend also requires you to be updated on the oil industry as well. This can be gained by specific industry niche publications and reports.